This is supposed to be risky. So it's a type of private equity funding that helps startups to achieve some early traction and growth, okay? In exchange of equity. VC gives you the money to burn. Sounds good, right? So how VC get the money back, which is acquisition, exit. Exit means you sell the company. Which means when you have a VC money, you will probably need to sell the company. Unfortunately, realistically, half of them gonna die. So even though you get investment, oh, we believe you, you're awesome, you're amazing, you're a PhD, oh, whatever. 50% chance that you or business, this investment going to be either go zero or not returnable easily in within the term. At the end of the day, there is not enough track record to be able to make a proper due diligence. So you need to have repeatable sales cycles, collected assets, contract, and many other things, right? So in order to make the first investment, you need to delay the valuation work. Thank you so much for everyone to join here. Okay, we're gonna talk about, guess what? Money, okay? Literally, we're gonna talk about money, right? Today we're gonna talk about the understanding how venture capital works for startups. A quick quiz, how many of you are a startup founder? Startup founder? Almost a half, all right? And aspiring to become a founder? Wants to be, you guys, all right? How many of you are, also people on the chat, there are some people also join online. How many of you are startup supporters? Like angel investor, all right, maybe. Mentor, any mentors? Okay, so good to know. Let's get started. So today, it's gonna be kind of like a one-man show actually, but I will try to make it as interactive as possible. You can ask questions, you can prepare your questions and so on. It's gonna be interesting because this is some of the, one of the most asked questions to us as an accelerator program and as an entrepreneur who supports entrepreneurs. Most people just wants to, get investment for their startup company, but they don't know how it works actually. So how the venture capital works, right? Are those like really like huge rich people that just they love you and they are philanthropic and they give money or something like that? No, right? Obviously, there is a business model behind all of this. So I understand that this kind of things needs to be tapped into, especially here in Japan. So I thought it would be great to be doing this session. Yeah. Okay, let's get started. So that being said, let's dive into the session. So we're gonna have total 7 chapters, but it's gonna be so much fun. Okay. First off, introduction of the venture capital, okay? Hold on. I think actually it's pretty boring finance topic, but it's about, entrepreneurship, right? About the startups. It's supposed to be a little bit creative. Most VCs that you see outside on most places, they generally tend to be suit, they look more business-like and things like that, not like me. A quick quiz. We know who is an entrepreneur or not right here, right? So I would like to ask, you can be, honest, do you know what venture capital really means? Confidently. What VC means? Venture capital. Expectation. Just like all investors. All right. I think most people don't really know the real meaning. Okay, let me explain. Okay, we will dissect the real meaning. Okay. So, have you ever pitched to the VC before? Okay, the second question, no need. Okay. So first off, in order to explain the venture capital, we need to understand what venture means. So the definition of venture is actually the risky or daring journey for or undertaking for something big. Expedition. So in a different meaning, right? But for startups, it's a business enterprise typically involves real risky. So with Japan, people call venture, they call it venture. Do you guys know what venture before, right? Venture, right? Okay. So this means startups. Okay. The capital, I believe most people have some understanding on the basic economics. In economic dictionary, is a capital means the capital that is defined as a physical or financial resources to use for producing value, economic value, right? And the startups is actually a type of asset. A company, your idea can be an asset, okay? That's what makes it a venture capital. So risky asset, literally means risky asset. All right, let's sink in, okay? This is supposed to be risky. You will understand soon, okay? So it's a type of private equity funding that helps startups to achieve some early traction and growth, okay? In exchange of equity, okay? So let's unwrap the venture capital a little bit. So venture capital is a form of private equity financing for early stage high growth companies. It has to be supposed to have a high growth potential. VC firms invest into startup in exchange of equity. They take some portion ownership. So investors supposed to be having an investor the risk involves very high risk, high return expectations, right? So giving you the funding to invest in the critical things that needs to be developed and expand. So VC gives you the money to burn. Sounds good, right? Sounds good. So we give you the money, let's say 150,000 or later stage $1 million to spend on your business. Such a luxury, right? It's amazing. Sounds good. Do you really think that a bank can give you this kind of money for this? It's not that easy. If you have a predictable sales cycles and so on, you might be able to get it. It's a long story. So type of businesses can get and like to get VC. So some of the four type of things that businesses, for example, if you're a SaaS platform and requires a high scale, large volume, you will probably require a VC funding. Initially, you might not need it. There is something called also bootstrapped. I'm gonna explain soon. Anyone who knows bootstrap means, be honest. So, for example, if you're a biotech or pharma startup, you will probably require upfront capital because barrier to entry to do that thing that you want to do, the commercialize in science, it requires a lot of funding, millions of dollars generally. All right. So, okay, I'm not gonna. I guess you guys get the core message here, right? So if it is upfront capital requires so much, you probably need a VC in advance, right? The businesses less likely to get the funding is like consulting businesses, service businesses, right? The lifestyle, e-commerce brands, that sort of thing. The local brick and mortar businesses like cafe and things like that. But it still could be possible to back by the venture capital or private equity, but it's a different game. It's called private equity. I hope I can maybe explain later, but yeah, it's different, okay? The niche software tools that targets too small or very few people use that kind of software tools might not be able to get funding. So, okay, type of investors. Investors are just like this. Friends and family. Have you ever heard what is 3F before? 3F? Friends, family, and fools, right? So they're in the same category. Why we would call this kind of savage name to them? Because they're really believers. In order to really believe something that this is going to work, I mean, you might have a full conviction, but really validating an idea will take time and capital. Okay, money. It will take time. So people who are early believers to you, probably your friends, your family. So angel investors actually generally they tend to be high net worth individuals, wealthier than average, that invest in the startup in exchange of equity again. They believe in you because they understand, because they tend to be ex-funders, exit funders, that sort of thing. Crowdfunding is, raising small amount of money from a large number of people to be typically online. So four types of crowdfunding exists, which is equity funding, crowdfunding, and non-equity crowdfunding has several breakdowns. Non-equity crowdfunding is that you make the pre-sales in order to make some upfront capital, so you produce a product and ship them later, 3 months, 6 months later. And there are also subscription-based crowdfunding platforms like Patreon.com. Couple, so you can subscribe and get the money, right? But generally for content creation purpose, but anyway, you can monetize. And there are also platforms like, this is my company actually, OpenFoco. So you can monetize partnerships and collaborations, to your business, but you can still monetize, let's say, event. You launch an event series in order to get some traction and money upfront to test your idea, get some funding, and so on. So we enable this. So institutional VC, this is what we are learning right today, is the venture capital. Venture capital is properly regulated by the government. It's a financial institution, okay? So it's a professional investor. Let's go. So why does this matter, right? Why we are talking about this one today? So for a startup perspective, funding allows you to get the funding from VC can accelerate the growth, which can also provide the strategic connections and bring valuable expertise. So over 70% of the tech unicorns have backed by the VC. So it's not a coincidence that 90% of startups fail. With funding, it also gets failed too, but you will have more likelihood to go a long way, a better way, right? But I'm not advocating this fully because this is not a religion. You need to have a very educated decision on, are you going to get funding and you sell equity or bootstrap? Let me quickly explain what bootstrapping means. Bootstrap means you fund your own company without selling equity for some certain period of time, right? Let's dig in. Which means sales, your own money, maybe your wife is supporting you. Who knows? It could be. or you're working for a part-time job, so you bootstrap it. So actually, VCs really appreciate this one, even though VC venture capital business model is for getting equity, because this allows you to learn, find a product market fit before risking other people's capital. So you can actually learn a lot better, faster, with your own way. Okay, this is very important. So this is called bootstrapping. Okay, so anyway, but unfortunately, VC is a very niche product. It's supposed to be this way. Not every business can get funding. Only 0.5% of startups secure VC funding according to TechCrunch. And other benefits are VC-backed startups can 3x growth faster than the bootstrap ones. And you have more like the 30% more likely to survive in, beyond 5 years. So if you want to survive more than 5 years, this is one of the options. But you don't have to, right? My startup is 6 years, bootstrapped, slow growth, but profitable, right? But it doesn't mean that all other startups are going to be this way. Okay, let's go. So let's compare the bootstrapping versus funding. One of the pros is that you can expect a fast growth, large networks, and big exits. If you're bootstrapping, you're gonna have more control, profitability focus, and fewer external pressures you're gonna have. So when you have an investor, they're looking from your shoulders, actually. How is my money? Like that. So they have generally a life cycle, let's say 10 years, generally. They will accept you, they're expecting your money back, their money back, right? Because they're raising capital from someone else. Do you know who? Yeah, LPs. LPs means limited partners. Okay, kind of, limited partners are really money owners, okay? So they also can be the institution and funds. I'll explain later. So what are the cons? Okay, the VC funding also means that equity dilution. The ownership shrinks, but it could be strategically make sense for you. I will explain. So investor pressure, less autonomy, and so on. But this becomes an issue, depends on the terms and side notes that you sign and in your term sheet. I will explain what is term sheet also. Okay, the bootstrapping is, cons are slow growth, which I'm experiencing at my company, Open for Code. But it doesn't mean that I can just go and pitch and get funding, actually. I'll just keep delaying the process because I want to learn really good. So, and so on, okay. And another risk for bootstrapping is actually, your lifestyle also shrinks. You use your personal savings, right? Generally, or the company savings. So it's a bit limited resource you're gonna have, so that kind of thing. So some of the unicorns, so this is really interesting. Some of the unicorn means over $1 billion valuation company, right? Startup company, high growth. VC backed, like obviously Uber, Airbnb, Slack, those are the famous ones who got almost around 50% of our portfolio is also like VC backed. So those are some of the most famous ones. Like they are not our portfolio, obviously. They're Uber, I guess Airbnb from the Y Combinator, it's an accelerator program, right? And Mailchimp, Basecamp, GitHub. Anybody who use Mailchimp? Yes. Oh, really a lot, right? So this is a huge success story. You should definitely go on YouTube and search what Mailchimp is and their story. I forget his name. He's a billionaire, right? His story is amazing. Some people reaches extremely high, growth and then $100 million in revenue, not even valuation. They make fundraising after that. This is also kind of the common pattern that I'm seeing. Okay, I think you can just take a photo or something. So because I'm not going to explain all of it because there are other slides that exist. I also want to give you a chance to talk, accept your questions as well. So I think everybody understands what is the difference between that. Okay, what are the merits of raising VC money for startups? You can get, you can scale faster. You can use it for marketing, teams, hiring. Things can get much more like world-class level. So you can fly, literally, like a rocket ship. So it gives you credibility, strategic guidance, market expansion, talent, and competitive edge. But many founders don't know how VC works. If you start understanding this, it's a waste of time. Let's go. So chapter 2. So what is the business model of the VC? Let's have a look. So where does the money coming from? This is the big problem, a big question. Where does VC get the money? From the LPs, right? But how? What is the business model there? Let's have a look. There is something called 220 model. This is such a very simple and basic business model actually. It means VCs charge management fees around 2% annually from the LP money that they raised, from their investors. They manage them. They're professional money managers. They pull the money around, let's say, the average pre-seed fund, how much? Like $10 million-ish. So you can expect like the 2% of it. So it depends on the fund size. It also could be rewarding, but I would say most of them institutions, professionals, it means they are actually getting salary out of this, right? So it's not a venture for them actually. But the carry is in the interesting one. So American VCs tends to be more carry focused. What carry means that you get the profit share after the sale of the company. You get the 20% of the money after the company become IPO or get acquired by other company when startup exists. So you get the 20% without investing, you having the 20% out of this, right? So this is the model. Generally, the term is around 10 years. You get the money for 10 years horizon, and they're expecting the return around 10 years. From the startup POV, VC funding is just like this. The VC get the LP funding, they source deals, they make the due diligence on your startup, they invest they proceed investment to help you to grow up and validate and so on. And there is generally some board seat involvement required, which they provide the strategic guidance to help the company grow even further, and happy to get exit to return on investment and distribute to the LPs back. As you can see, if you're an LP, you will probably lock your money for 10 years. So it's not that easy to make money out of this, but actually in a scale, if it is the right model, it's actually could be profitable. So how VC get the money back, which is acquisition, exit. Exit means you sell the company. Which means when you have a VC money, you will probably need to sell the company. Okay, when we hear a startup fail, right? So it actually means that the company rehibernates, like it's not able to get any further funding. It become a normal company technically. So the general VC is expecting you to become a unicorn business. Unicorn means $1 billion valuation business. So this is a numbers game. So it requires diversification and big numbers of investing, number of startups require. So this is a real chart from a VC, a real VC, okay? I'm not gonna tell who it is. Anyway, so this is how the distribution look like. So we're expecting, this is the reality, like nobody will show you this one, okay? Please keep in mind, nobody gonna show you this one. Unfortunately, realistically, half of them gonna die. It's like, even though you get investment, oh, we believe you're awesome, you're amazing, you're a PhD, oh, whatever. 50% chance that you or business, this investment going to be either go zero or not returnable easily within the term. But out of the half, maybe, but it's also yields. For small, if I want to bring back the entire fund for 2x, so I'm going to expect like 60 of them going to be fail, 35 of them going to get a small return, like maybe entire money or 2x of the money. But mild means like mid-level one is like maybe 10x, 20x, but high is like outlier return going to bring. But if it is a small return, I will probably not able to hit any unicorn. So possibility of getting a hit in a unicorn company starts from like being able to invest in 100 businesses actually. Get into the deals like 100 businesses. If you're a pre-seed, like early stage investor. Sometimes, you will probably see some VCs, you go to their website, you will see a lot of unicorn companies. They could be a late stage investor. They know this is going over the unicorn path, so they put the money there through co-investments. That's a different story. So there is something they call J-curve, early losses, then larger returns comes later, just like a J shape. So if I'm seeking an outlier return like 8x of the fund, $10 million to the $80 million, I'm gonna need to hit maybe 2 unicorn companies. Can you imagine how less likelihood to be hit a unicorn? So it's just crazy to like in terms of mathematics. Most people like we have a big hope. I'm on VC money. Without VC money, I'm nothing. Like that kind of impression people have, but actually no. So how VCs evaluate based on the team, market, product traction, competitive edge, and deal fit. I believe the most important things actually here, 2 things, in my opinion. I mean, for my case, the deal fit and then the team, which is you, literally. Because in terms of early stage startup, you exist in the company. You're the biggest asset of the company, the founder. That's why we have this, we name it this way, the Founder Institute. So, because we would like to help you to gain more skills and capabilities, network and stuff like that. So you are the one who's going to build this great company. So that's why one of the most important assets. The deal fit depends on my requirements, our requirements, our firm. So we are enforcing or seeking some terms. I'm going to explain the thesis. So chapter 3 is the funding stages. Those are, probably you hear a lot, right? So series A, B, C, D, right? Told you, this is kind of boring topic, but what can I do? This is the reality. That's why you need to force yourself to be learn. So very few resources out there teaches or shows the inside of how VC works. There are some common stages like pre-seed, seed, A, B, C, D. Okay, why the name is like this? Let's have a look. So pre-seed stage, generally idea or early prototype, maybe MVP, maybe. Pre-seed is extremely early stage, right? Generally, being able to invest something like this, we need to work with an accelerator, incubator, and so on. It requires to be a belief on you, right? The personality. So it seeks generally 10%. It's we spot around 10%-ish equity, but there are many other different models, something like this. It depends, ranging, depends on the deal, okay? So type of investors from a pre-seed, you can expect angel investors, friends and family, accelerators, incubators, and there are some VCs emerge. For example, graduate of the VC lab, do we put a number here? Yeah, 88%, but actually this number changed. Yeah, roughly 90% of the VC lab funds, which is around 600 of them graduated, $1.5 billion, seeks pre-seed investments. Thanks to, because Founder Institute expertise bringing, so we are enabling to be able to invest in the pre-seed. Being able to invest in the pre-seed is extremely hard. It requires a lot of sophistication. Below level is kind of like an institution is investing in you. It's more like private equity. The supports you can expect is always the mentorship, networking, product development, early market validation, and so on. Okay, how about the seed stage? Seed is generally, you can expect around $1 to $3 million in funding. So, but if you have some validation, early validation, MVP, a strong team, and so on. So it needs validation. Most of the accelerators are famous accelerators like Y Combinator, 500, and stuff like that. It's actually seed. So you need some early product and traction in order to begin. And VC also gets around 10 to 20%. It depends on deal ownership stake they seek. But there is something called the instruments of the investments also different. I will explain soon. Series A around 5 to 20, valuation around 20 to 100 million, and VC ownership around 15 to 20% per round. Series B is way beyond. It's generally seeks growth stage. So Series A is the early growth stage, right? You have around $1 million in revenue, and maybe 10, 20 people team. So you start to see that repeated pattern of sales coming up. You also have like founder-led sales, or you have small team emerging, that kind of reality change. So your personal reality also starts change. But after Series B, things getting very rare. I don't know exactly how many percent able to reach the B, but this means after this stage literally means pouring gasoline on a fire, right? So you're gonna see this curve. We are expecting the curve like initial first two round like yearly quadruple growth, then double digit growth, doubling the company every damn year. So every stage, so your cap table is very extremely important. Please don't divide it like equally or give away so much equity in advance. Between fund is debatable. In my personal opinion, it shouldn't be super equal, 50-50 or something like this, honestly. So this is what makes it unbroken and uninvestable cap table. Still some of them are able to get funding. Long story, but this is like rule of thumbs, right? So best case is like every round you sell like 10%. You're selling your equity. You're on an asset company. If you're able to reach the Series A, but of course this is like a perfect world scenario. So we're gonna publish this one as a video as well. So watch out some of the beloved universities. Okay, so I have to write a little bit more kindly this one. So some universities and corporates have programs that makes a spin-off, but they get a big. Sometimes they able to get a big chunk of equity because they say you're gonna use my laboratory. Here's some university funding and so on, but you might lose a big chunk of your equity in advance, and then we see just because I might not be able to even invest. Because what is going to be your future equity? What if after Series B you will lose your board rights to control the company? So a private equity guy, a salaryman going to manage the company rather than you ambitious people, right? So it's kind of watch out. So some venture studios, but venture studio model is changing. Venture studio, what is venture studio? Okay, ChatGPT please. So it's no time for that. Let me check the time. Okay, terminology, quick terminology. Well, due diligence means basically the assessment of the company before you make an investment, obviously. There is a legal DD, there is a technical DD, and so DD means due diligence. So I'm not going to go and dive into that. The term sheet means the legal document outlining investment terms. including valuation, investor rights, ownership percentage, yada yada. It serves a foundation for the initial investment. Generally, first investor are the one who draft the course, but after that you receive each round. Valuation, okay. Valuation means your value of your company. This building has a value, right? The value of this building generally created by the land, the material costs, labor costs, everything you pile up, and then you have the kind of premium on the top, and that's it. So you probably have a solid market value of this. What is that building? Mori Business Tower, like something like this, right? It's a pretty big tower, right? But the valuation of a company, a startup company, could be very different. You might see a 10-person company would be more valuable than entire this building. I don't know, maybe 500 million, maybe this building worth. Could be, right? I don't know. Let's say $500 million or $1 billion to build this kind of building. This very big building. But a startup could be more with just 10 people. So watch out again. Someone who wears a t-shirt or looks different or nerd a little bit, right? Otaku, could be a billionaire. Watch out. So, especially in Silicon Valley, it's not that, you know. Rather than that, we discriminate by the people who wear suits. Okay, valuation is like how much worth the company based on how much shares you sell. So what is the convertible note? So how are you going to sell the company's your shares, right? This is a big question in terms of feasibility and the logistics of the getting investment. So in order to avoid this complexity, make things easier, I guess lawyers invented some sort of different, legal terms, legal systems to be able to get funding easily and delay the valuation. So underlying idea there is it's so hard to make an evaluation for early stage company. Jessica comes in and says my some company is a $10 billion worth because I have a PhD, right? So or I have one client that is amazing. At the end of the day, there is not enough track record to be able to make a proper due diligence. So we need to have repeatable sales cycles, collected assets, contract, and many other things, right? So in order to make the first investment, you need to delay the valuation work. It's getting a little bit complicated, I know. I'm going to explain a little bit more. I need to explain more. So convertible note helps us to not set the valuation initially and give you the money for the future equity. Future equity. Stay with me. Is anyone knows what SAFE means? You can raise the hand. SAFE, obviously, right? So did you know that SAFE is actually not invented by the Y Combinator? It's actually conceptualized by the Adiresi, the founder of this. So Adiresi conceptualized this in collaboration with the mentor, lawyer. That lawyer goes to the Y Combinator. It was the early stage of the thing. Y Combinator as well. So it was called the convertible note, simple convertible note, and they find the final version of there, become more well-known and used there. So it's a legal term that enables investors to fund startups in exchange of future equity without initial valuation, delaying the valuation because we don't know how to do. That's what we admit. It aims to simplify the early stage process and so on. So we invented a way how we can give you money conveniently without overthinking. So it allows you to make the due diligence so easily, could be even a week, or during the program, an accelerator program. Oh, this is good. This person gonna make it. All right, cool. Let's write a $150,000 check with a convertible note because we don't know that we're going to be able to make valuation right now. So with a convertible, so easy. So SAFE, one of my favorite. I love SAFE actually. This is great. So what is KISS means? This is the 500 startups version. They invented this. Keep it simple security, similar to this, but the terms, the ingredients is a bit different than that. It's generally requires some trigger event to be able to convert either equity or debt, which generally comes with the interest rate. The interest rate could become with an equity or debt as well. Here are some difference between SAFE, KISS, and JKISS. JKISS in Japan KISS, technically. We can take a photo and you can have the deep dive later because I don't want to go too much deep in that. If you have questions, I can explain at the end because I want to manage the time. We start this session late because of the previous session, so don't blame me. Right? Okay, liquidation. So let me explain some of the important things in terms of understanding how these notes work. Because when you get an investment, accept an investment, you actually need to know what is a term sheet all about. All right, be honest. How many of you see a term sheet in your life? Because majority don't see it yet. Let me explain what term sheet means. Go ahead. Okay, term sheet. Here you go. It's kind of for most startups that join our programs, it's very scary thing. Like I don't understand anything. It's a lot of legal jargon. Blah, blah, blah. Okay. Term sheet. Okay, term sheet has a lot of. Okay, Termsheet has many ingredients, sets the terms of the deal. So the conditions, terms and conditions of the deal. Okay, some of the, if I can explain the conditions of the deal, this partnership agreement, you will understand better. So for example, some of them are liquidation preferences. It determines investors a payout in case of an exit, and which ensuring that they can get paid before common shareholders. So priority payout. This is one. I'm gonna go through like a rapid fire, so you will see the pattern instead of me trying to explain waffle. Pro-rata rights allows exit investors to maintain their percentage of ownership in a company given by the rights to participate in the future round. So I reserve my right to be invested in you. This could be purpose by design. Drag-along right enables you to withdraw, actually, sell their shares in an event of acquisition. And there is also something called SPV, which is special purpose, but why does it come here? I don't remember. So anyways, here are some common terms, some ingredients, so to speak, in the term sheet. You will see a valuation cap in your safe note, especially in the safe note. So it's a limit, that a psychological barrier, like agreed upon a barrier, that you will probably have this kind of value. Again, this is completely willpower, so the will investment. So you will probably have a $10 million value. You say it, they agree for some current conditions, but the conversion happens when there is a equity run happens in the future. So it's a delay process. When we give the money, we voluntarily give the money with this special note, special agreement, term sheet, the safe note, to convert in the future. So this allows you to allows the investors to protect from excessive dilution or vice versa. So valuation cap could be beyond the 10 million, let's say, or less than that. So there is something called discount rate. This allows you to be able to get. So let me explain the logic there. So, okay, otherwise it's going to be so much confused. Let's say Jessica and I agree that the company worth $10 million, and then we issue $1 million, right? Stay with me. So what happens if the next investor sets the valuation $20 million? My agreed upon shares for $1 million for 10%, right, become half. Able to acquire the half of 5% of the money, right? Did I lose my shares? It sounds like that, but I'm able to hold a smaller value, but for a bigger company, okay? In some cases, you would require to get a discount rate to reward me because I am an early believer. That's the logic behind. What happens if the valuation, the conversion happens in the 5 million, half of it, so I'm going to be able to get 20%. I guess we are all on the same page, right? Okay, because it's getting more complex. I understand that. You guys also get bored. And if you have questions, you can brief these questions. I think pre-money valuation, that kind of thing is a little bit technical. I'm not going to be diving into it. There are also side letters that separates the agreement, may address different terms and conditions on the side. So watch out them. Try to be very cautious. You need to understand your term sheet and everything is written inside, which there are many things inside actually. Cliff investing, governance, drag-along rights, pro-rata rights, liquidation preferences. This is also you need to watch out, and so on. So there are many other things actually. I try to fit inside the most important ones that you need to watch out, and so on. So your job as a founder before and after investing. So before getting investment, list building, talking to VCs, evaluate and diverse due diligence to the investor. Are they really able to wire money? Are they really able to are they really VC or not? First you need to check it. They might maybe pretend like a VC, right? Watch out. So evaluate better. And then you gotta also pitch a lot to iterate so you can see the pattern. Without, just like every other human endeavor, right? Without really practicing a lot, you will not be able to see the pattern to be able to, see what you need to be improved. All right, long story again, if you want to take a photo, you can take a photo to understand more. Oh, okay, I can come back. So what happens after you get the funding? You have fiduciary duties to report your investors. You have set agendas, some particular meetings and responsibilities and so on. So financial duties, KPIs, milestone updates, quarterly or annual reports, board meetings, strategic discussions and so on. And compliance and legal things. All right, lastly, let's have a look what the VC wants from your pitch deck from a VC point of view. average VC sees 100 to 400 per month cold emails. So even in the earlier career, as a new fund, they're overwhelmed with a lot of things, just like job applications. So you're gonna need to be, please help them to be proceed the information faster, easier. So you will have more chance if you introduce them with a warm introduction for sure. But if they are already established as a fund 2 or fund 3, they will be high in demand actually. Just most of them are. But some VCs are by design, by choice, they invest in the co-investment, so they don't open the case, they join the cases. Co-investment. Okay, so this is kind of obvious. I think since we time almost run out, sorry for I couldn't utilize the time very well, but those are the things that I can send you via message or email to, because most people register for this. So basically these are, from now on, I add here for your convenience. So what are the slides, what you need to be careful to put into your slides in order to convince the VC, what they're looking for from their POV. No jargon, framework for pitch decks, because there is a very likelihood that your pitch deck is killing your fundraiser process, okay? For each type of slide, I will give some pros and cons and some ideas here. I will be showing the screen one by one for recording purpose. Solution, the market, traction, competitor, team, timing, the ask. So the ask slide is the one of the slide that stays the most in the screen. So you need to utilize very well. You need to write what you're asking, depend on the legal requirements of the region of the law, or the event itself is a demo day or not, that kind of things. You might not be able to actually disclose or solicitate what you're asking investment publicly in some places in the law. So you need to also watch out that. Okay, people behind the VC are GPs, LPs, associates, analysts, and venture partners. Just like most of the other type of partnerships organizations, like sole proprietorship partnership organizations, like VCs, consultant firms, legal firms, and so on, they have the similar type of alignments, the hierarchical system. So they have the general partners, there is the other partners, and the LPs are the one who invest them, associates that supports them, and so on, the analysts and so on. That kind of titles they have. Most of the time is actually deal sourcing if they're in the fund vesting mode. If they're in the fundraising mode, just like you do for fundraising, they seek fundraising from the LPs. They go a pitch, but also way more restricted than a startup gets funding, seek funding, a VC gets funding. So it's so much restricted because of general solicitation rule. Just like try to sell cigarette or alcohol in a Muslim country, for example. You can't sell alcohol in Turkey, for example, in my country. So you need to be very clever in order to make the marketing, okay? For VC perspective. So if they are in the investing mode, generally half of the time, average, goes evaluations, okay? But if they're a higher level partner, they might be trusting to the other partners to get in deals and so on. Japan POV off. I'm not gonna get it. Okay. If you're curious, I'm gonna do this because previous session also finished late, so that's why I couldn't manage it. Apologies. Any questions from now? Japan, I will let remain this one. Okay, this is important. So meanwhile, I can accept some questions. I think they're gonna give me more time because okay. Thank you so much, and questions are very much welcome. Okay, Dozo. Let me give you a microphone. Oh, maybe you can come here to ask the question. Convenience. He's giving to you. So it's okay.
So thank you for your time for explaining, those informations. I'm, pitching to the VCs right now, and the valuations and the amount of investment you put on the presentation is based upon I think US, and the size of the investment in Japan is much lower, right? So exactly. How much difference you see in average between US and Japan?
It's a tough one. So it's actually related about this slide. So I mean, obviously, United States is a much more mature market in terms of venture capital and much more competitive. And the deals is slightly a bit more inflated, especially currently in Silicon Valley, very much inflated, especially if you have AI in it. If it is a foundation model or something like that, oh my God, crazy. So much more inflated than here. This is what I see. But in Japan, I mean, fundamentally, America is much more in the spectrum of capitalism. So, so better terms I see, better founder-friendly terms I see, and so on. But your question is like, could you a little bit more specify, like, what do you really wonder?
Yeah, well, as an example, the Series B in the US, I think the company in Japan most likely having the kind of valuation means go IPOs, right? So I like to kind of understand that if the investments from Japanese VC is let's say 1/10 of the size of the US, or in average, I like to know
Size of the
let's
money
say,
that they're going?
seed round, let's say, in the US, they can make, the $1 to $3 million investments, but in Japan, the seed round, I think much, smaller, right? So I'd like to know what's the ticket size difference,
I mean, it's really case by case. It's hard to say. It's less for sure. It's less, but it still depends on the deal. So it's okay. We have first off, Japan ecosystem is up and coming, still emerging. That's the one thing. Second thing is investors tends to be much more institutional here. So we have less pre-seed investors specialized in pre-seed. That's because they don't have understanding yet, right? So the third thing is they have less risk appetite, so they want more structured deals. So more mature companies they want, and so on. So, and also you might not be able to find easily the wealthy people contributing to the venture ecosystem to be able to provide the funding. Those are some several reasons that it's less. So my answer is that I don't know exact percent. I'm gonna need to double check on that. I don't know exactly. So less than that, from the U.S. market, especially Silicon Valley, and those are some of the reasons. I'm sorry that I cannot answer precisely. Any other questions? Those are.
So at the very beginning, you mentioned that generally when it comes to VC, companies are looking for something that's going to be a unicorn, have a giant global impact. But looking at this chart, let's say that you had something that was more focused in the Japanese market. If you're pitching to a Japanese VC, is that actually, on the other hand, more attractive to them because it's localized to their market, or they're still looking for something that potentially has this high risk, giant global impact, even though they're generally more conservative with investments?
Okay. I had to see that again, the case by case, but I will explain. Okay. So in Japan, they tends to okay. If you're only looking for a local market, there are some very few international investors or investing only if you're looking for a local Japan market. There are some other VCs that are bringing the global companies to here. Maybe you might want to be able to attach them. But I'm talking in the context of very early stage, pre-seed stage investment. So if you're looking for it is an idea that really needs a global expansion, some might not be able to survive or get a big market size in the local market. You will probably need a global investor, a global-minded investor, or a global accelerator, or a VC that understands or have a network globally. So VC is a very human-driven business. It's a human business, actually. Even though we work with the technology companies, you need to have the very core capabilities be able to get the global expansion. Depends on your idea, your business, actually. So I have to mention one more thing here is the market size is one of the important thing, but not the only thing, important thing, one of the important thing. If you have like a very limited market size, you might not be able to, if you are not able to show the growth of the market, you might not be able to get the funding easily, honestly. So it means maybe the market is not exist yet initially. Maybe it's going to go global. Maybe you're initially investing to the local market. Let's say a travel industry. I was talking, right? The gentleman behind. So he's targeting Nico, right? Nico-san. So targeting initially here. So it will be duplicate that same thesis that works here locally, incubate here, duplicate other similar markets rapidly after that. This is also kind of idea. So really, you need to have a superior strategy in order to be able to convince that investor, to go global. it actually could be investable. So if you are, I want to double down here, a couple of years, I will reach this milestone. Then after that, I will duplicate it to the this markets, emerging markets, let's say, or the US market, and so on. Or you would want to start from the zero, day zero, global from the day zero. Some companies, some investors also. Recently, I'm collaborating with one of the VC from Europe that wants to expand in this region, wants to make investments and so on. They say that we don't want even invest as a startup that who is write their own local language in their website. Have to be English by default. This is their criteria. We have to, I mean, if it is not aligning with you, you can just go to another one, basically. By the way, I have to mention that co-investment is a very common thing. So you don't get to check one from one investor. You would need to have maybe multiple investors. That's why I was explaining the SPV here. The topics, these topics open other topics because it's a very deep topic actually. We need more time to be explained. Yeah. Does it explain the question? Is it as well? SPV, I was explaining somewhere. Yeah. So if you have more deals coming up, more investors coming up, interest coming up, you might need to open an SPV to collect all the investors in that SPV. It's a tiny fund, so to speak, that invests to your company as a one investor. All right, shall we wrap up? So if you have any other questions, please feel free to connect with me. And I know you have questions. I know you get bored. I know the topic is very boring, but it's about money. So it can really change your life and change the trajectory of the company. It can give you the fuel that really makes an impact on your whatever you're doing, make it global scale. So venture capital seeks extreme high growth potential, 1,000-time growth potential. You need to pursue, you need to demonstrate in your business. It's not for everyone. It's not like bank loan or nothing like this. Okay, it needs to be it needs to be approach every deal that invests. Let's say 100 deal, like oh, there's a potential that it's going to be $1 billion company, so on. Thank you so much for this, and really appreciate it for joining me. And if you have questions, please feel free to reach out. Thanks, guys.